Okay, so welcome to our recorded lecture on equity method for investment in associate. Okay, so when we talk about associates, we have to look into the extent of influence of the investor over the investee. The investor, of course, is the one who purchases shares on the investee. The investee is the one, of course, being influenced or sort of owned by another entity. So, as a rule of the thumb, if there would be 20% or more of the voting powers being held by the investor over the investee, the presumption will be, of course, the investor has insignificant influence. But then again, you have to check whether there will be uh, a true significant influence. Later on, we'll discuss about that. Now, if the holding of the investor is less than 20%, the presumption will be the investor doesn't have a significant influence over the company. And it says substantial or majority ownership by another investor does not necessarily preclude an entity for having significant influence. It works like an investor with significant influence has at least a say, or the voice will be heard during the meeting, especially in the annual general meeting. So it doesn't they cannot just be ignored by significant or substantial owners of the company. At least they will be heard, or any suggestion can be noted. Now, the existence of significant influence will be tested, or can be seen or tested on one or more of the following ways. It says here representation of on the board of directors or equivalent governing body of the investee. Participation in policy-making process, including participation in decisions about dividends or other distributions. Material transactions between the entity and its investee. Interchange of managerial personnel or provision of essential technical information. If one of these are present over the investee, or being represented by the investor over the investee, then there will be significant influence. So in that case, what we will do in accounting, if we can prove that there will be significant influence, is to account for the investment under equity method. Now, in equity method, okay, initial recognition of the investment is obviously at cost. If you purchase it, that will be the cost, and any, of course, incidental cost in acquiring the investment. And then it will be increase or decrease, okay, depending on the profit or loss of the investee. And the investor's share of investee's profit or loss is recognized in the investor's profit or loss. Distribution received from the investee is a reduction of the carrying amount of the investment. So example of that will be dividends. If the investee declared or distributed dividend, then it will reduce the carrying amount of the investor's interest. Okay? Of course, it will affect the investment account. So example problem here, ABC Limited invested 200,000 kina in DEF for 20% ownership. It was determined that ABC has, or ABC Limited has, a significant influence over DEF Limited during the year. DEF Limited net income was 50,000 and declared and paid dividend of 20,000. So our requirement here is to journalize the investment made by ABC Limited, including transactions related to the investment. So remember, if there will be net income or profit from the investee, that will increase, of course, the proportionate share, in this case 20%, that will increase in the investment of the investor. And any distribution made, in this case dividend, it will reduce the investors in investment, of course, depending on the percentage of ownership. So journal entry will be, so to journalize the investment, debit investment in DEF and then credit cash at bank. And then for the share in income, so that will be debit investment in DEF and then credit investment income, 10,000 kina. So this will be part of the PL, okay, or profit or loss statement. Okay, so there will be calculation down below, 50,000 multiplied by 20%. Now, with regards to cash, with regards to dividend, that will be debit cash at bank, and then credit investment in DEF. So, as you can see, the dividend paid or received from DEF actually reduces the investment account of the investor, which is ABC. And that's it for my discussion and recorded lecture. Thank you for listening and hope you learned something.